Hello, bonjour. Welcome, everybody. My name is Eric Chaput, Business Advisor here at the World Trade Centre in Winnipeg. I would like to begin today's webinar with our land acknowledgement. We acknowledge that we are gathered on the land of Treaty 1 territory and that Manitoba is located on the traditional and ancestral lands of the Anishinaabe, Anishinaabe, Innu, Denisolune, and Dakota Oyate nations. We acknowledge we are also on the homeland of the Red River Métis and that the northern Manitoba includes lands that were and are ancestral lands of the Inuit. The World Trade Centre Winnipeg team respects the treaties that were made on these territories and acknowledge the harms and mistakes of the past and present throughout our nations. Thank you all for joining our webinar, Small Business Tax Planning, which will be presented by Peter Moreira. Before we begin, I want to share a few housekeeping items. Please send all your webinar questions directly to the chat box at the top of your screen, and I will try to answer as many questions as possible during the session. As well as the Q&A session, you guys can answer or send your questions during the session, and Peter will be answering that. For all logistical questions, please send them directly to the chat box and I will answer your question as soon as possible. You will also receive a PDF copy and the recording of this presentation within the next week. All right, let's start this webinar. I would like to introduce you to Peter Moreira. Peter Moreira has over 15 years of professional experience in financial management, economic development, business consulting, planning, and teaching. He is a chartered professional accountant, holds an MBA graduate degree, and a Bachelor of Commerce honors undergraduate degree. His experience includes key roles in business startup, expansion, and successful sales of numerous business in Manitoba. This expertise is supported and enhanced by his previous role as a CFO with the province of Manitoba government and as an assistant deputy minister. In addition to his consulting practice, Peter shared his knowledge and experience as a continuing faculty member at the University of Winnipeg in the Business and Administration Department, and is a regular session leader in the professional education program with the CPA Western School of Business. All right, welcome, Peter. The floor is all yours.
Okay, thank you very much, Eric. Appreciate the introduction. Welcome, everybody. Thank you for joining. So we've been doing this, I guess, annually now for 1 or 2 years and seem to have had some nice success with it. It's a nice little check-in around what's going on with some business-related tax items. So happy to be here again this year as we move into closing off one tax year for many and starting into another one. So today, I just picked a few things here that thought would be of relevance to many business owners, working shareholders. And so we have a couple of different things that I'm going to go through. We'll start off with going through some of the available tax credit programs for Manitoba businesses. So these are tax credits offered by the province of Manitoba. You would certainly get them and get access to them by filing your corporate tax returns. And in some of these, many, even if you're sole proprietorship, they are certainly applicable. But you would have to file a tax return in order to get access to these credits, but these are provided by the province of Manitoba. And there's certainly more, but I picked some that were, I think in my experience over the last number of years of working with small, medium enterprise sized businesses are ones that tend to come up and seem to be fairly valuable. And then we'll talk about just a few of the updates to rates and items like for capital cost allowance as it relates to vehicles. Those tends to be really of interest to working shareholders and small businesses around rates and allowances and those kinds of things. CPP, a couple of tax planning considerations, and then I had added in the Canada tax benefit, Canada dental benefit previously, and just talking just a quick update on what's been expanded with that program because it's one that's being phased in and enhanced yearly over time. And then, of course, like Eric said, if there's questions as we go, please certainly ask. It is meant to be fairly interactive. If there's kind of questions that come up about maybe some ancillary or periphery things to the topic, certainly feel free to ask. And if it's something I can answer, usually I should be able to. If not, I will let you know where you can maybe go to find the information. Okay, so some of our tax credits available in Manitoba. One is the Small Business Venture Capital Tax Credit, SBVCTC, as sometimes people like to call. It's one that I talk about quite a bit with small businesses, small medium enterprise size business, especially those that are starting up. Because if you're in a stage where you're starting up your company and you are willing to take on investors, this is a really valuable program. So this program, it doesn't put cash into your hands as a current owner of the business, but what it does is it incentivizes investors or others to invest in your company. So for someone that would, what this does is it provides a tax credit of up to 45% to individuals or corporations that invest in your company. So if you were to, let's say, sell shares of your company to an investor or to someone else who wants to become an owner, whatever they've paid for those shares as the investment, they would get a 45% tax credit on their against their Manitoba taxes payable. And so for startups that are looking for capital, willing to take on other owners, this is definitely a really great program because it de-risks the investment to the investor, right? Small business, we all know, is certainly risky. Unfortunately, the stats do tell us that many small businesses fail. And so attracting capital can be difficult. So this is a really great program to help de-risk investing in small business. To be able to ensure that your investors can access this program, you would have to get pre-approval from the province to register. It's not an onerous process, but it is a process, and they're a great department. They're really easy to deal with. If you're a brand new startup, you would need your accountant or your lawyer professional just to confirm that you're a startup. If you've been in business already for some time, then you would need to provide some information like tax returns or financial statements to show that you've been in business. But to qualify, it's not overly difficult. You need to be what's called a Canadian controlled private corporation, as is consistent with many great tax credits that are out there, which means you need to be a corp, in this case, a corporation, and your corporation needs to be controlled by Canadian tax residents. So at least 50% of the shares are owned by Canadian tax residents. That's not an immigration status. That is a status where the individual or the corp is a tax resident of Canada. The corporation has to be doing active business. So it can't be a corporation that invests in real estate and just earns rental income or passive income. You have to be doing active business and generating revenue from active business. And you have to have already had $25,000 invested in the business. So if you are brand new startup, at least 20, you as an existing owner would have had to already invested, or by the time that, your approval is done, show that you've invested at least $25,000 into the business. And so who this is for, your revenues have to be less than 15 million, less than 100 full-time equivalent employees, which generally is the definition of a small business in Canada. Less than 100 employees, that's one of the definitions anyways. And at least 25% of your employees need to be in Manitoba, and not a reporting issuer means that you're not like a publicly traded company. Investors can invest a maximum of $500,000 per company. I think the minimum is 10. So if you run just kind of the math on that, if someone invests $10,000, let's say in your company, it really only costs them $5,500 because they're going to get a 45% tax credit on that $10,000 investment. So they're going to get $4,500 back when they file their taxes if they have Manitoba taxes payable. If they don't, they can carry forward that credit, and I think even carry it back, but they can carry it forward for sure. There's a similar one that I won't spend as much time on, but the kind of partner to this particular tax credit is if your company is a cooperative. So there's a similar partner type of tax credits called the Community Enterprise Development Tax Credit. Still the 45% refundable tax credit to the investor. But this would be the program you would use if you incorporated under the Cooperatives Act, and a little bit more leeway in terms of the uh, qualifying, so less than 200 employees. But other than that, it's fairly similar. The maximum is less though, so investors can invest a maximum of 60,000 per year. Um, but good that there's a little bit of a partner program if you incorporate it under the Cooperatives Act. Any questions about those two? Okay. This is also kind of similar. If you are in a position where you are, needing to or want to take on additional owners, but within your own employee base, this is an incentive for your employees. So there's a tax credit for the employees to purchase shares. This is really great to use if you're doing any kind of succession planning, looking at a business takeover, buying into the company, like your employees want to do that. And so really great because this is again something that will lower the cost of the employees to buy into the business and de-risks it for them, right? Makes the cost of their investment a little bit less expensive. You have to have a registered employee stock option program already created and set up. Still need to be a Canadian controlled private corporation. 25% of your employees being in Manitoba. So it's very similar type of criteria. And there certainly are some maximums in there as well that you can see on the screen. And then mostly to do as well with timing as to how much cash gets refunded. But generally in 1 year, the employee can get 27,000 of the tax credit being fully refundable. If they invest more and the tax credit is calculated to be higher than the 27, let's say the maximum is 67.5 in the year, they can carry that forward or backwards. But this is really great. I find that I added this one compared to last year because what I've been really hearing and talking about with a lot of clients over the last year are things like employee-owned trusts, which I don't have here because it's a little bit more of an advanced conversation, but certainly there's a lot of discussion lately around having employees participate in ownership in the business. So this is a tax credit that's been around for quite some time, maybe underutilized, and I think it's definitely great to get out there to enable employees to buy into the business, especially if you as a current owner are looking at, some succession planning or maybe looking to start stepping away and doing some other things and taking on some other ownership and getting some equity that way. This one's a little bit more of a niche type of tax credit. There are a couple other specialty ones, but this is definitely one that I hear about a lot. It's the Manitoba Interactive Digital Media Tax Credit. So this is 40 up to 40% tax credit, and this is a tax credit to the corporation. So if you are doing work, and I'll talk about what the eligible work is, but if you qualify for this, the company gets a 40% tax credit on any qualified labor expenditures, some marketing, distribution that you've incurred in developing what is called interactive digital media. And so for it to be interactive digital media, what you're developing has to be a combination of both software, data files. There has to be a combination of, text, sound, images like you're seeing there. Basically, it can't be just an app. There has to be some kind of interactivity between the application or whatever it is that you're developed, the software that you've developed, and the user. There's a little bit more detail, obviously, in the application package. But this, if you think that you're doing anything that's like video games, simulators, any kind of software that's multi-path that requires participatory e-learning products, those types of things would be really good. Great way to, if you are developing and creating that type of product or content, great way to get some money back and to lower the cost of your investment into those products that you're ultimately going to be selling through this tax credit. This is one though that you do have to pre-apply for. You have to apply in advance before just including the expenditure information on your tax returns. So you do have to apply first and get that certificate of eligibility. And then once you have that on that next tax return is where you would file the claim. Okay. And then the last tax credit that I wanted to talk about that I think is a really good one that I've kind of seen as being a little bit underutilized, at least in our client base. We're trying to really get the word out there is paid work experience tax credits. The terminology, if you look this one up on Manitoba's website, it's been consolidated a little bit. There used to be one labeled as the co-op graduates, apprentices, and all those kinds of things. Now it's just all under the category as paid work experience tax credits. I just saw a quick question come up. I just want to address that because I think it was on the last item. He said, e-learning, does online training qualify for the digital media tax credit? So I don't want to say a hard yes or no on that one, but if it is delivered in an online environment, it has to have some kind of interactivity with the user. So it doesn't need to be, you don't have to have like an active prof or lecturer or person delivering the content, but there has to be interactivity in the learning. So I think Judson, with that question, I think that's definitely one where if you think there's interactivity, if there is e-learning, I would definitely reach out to the folks at the Manitoba office that delivered that managed the program. Happy to make sure you get that link, and they would certainly be able to go through what it is that you do and do a bit of a pre-discussion. And if you qualify, I definitely encourage you to explore applying for that eligibility certificate with them. Yeah, definitely. Eric, if we can maybe make a note to get Justin that link, that would be great. Thank you.
Okay.
So the paid work experience tax credits are, oh yes, Mercedes.
So, sorry, there is a tax refund when you have students in your company or corporation that is helpful to supporting, I don't know, the community, but also for the company as well. Can you explain a little bit more about that, please?
Sure, yes. So these tax credits are the ones that you're seeing on the screen here are that the company, and you don't have to be a company for this one. If you are a sole proprietorship, you can still look into these. So if the business, and I'll say the business instead of corp or whatever, if the business has hired, there's kind of three categories here. The student does have to be part of a co-op program. So if it's a co-op program in post-secondary, so at one of the universities or Red River, if it's a co-op, you go to that co-op program, say, I'm willing to take on a co-op student, and you hire one of those students, whatever you pay that student, you would get 15% back of the wages if it's a co-op student in post-secondary, and you actually get 25% back if it's a high school student. It used to be only vocations, but they've enhanced it recently in the last couple of years where it could be in other industries like healthcare and all that kind of stuff. So you want to find a high school that has these programs with these students that fits, and then you would get 25% back of whatever you pay to a maximum of 5,000 per student if it's a high school student, 5,000 if it's a co-op student while they're in the co-op program. And then the middle one is even after the co-op student graduates, if you keep them on, you can still continue to get that 15% back. It's just the maximum is a bit less.
Okay, that sounds good.
It is a really good program. So I have clients that do this one right now with the co-op, the post-secondary co-op, like for tech development, software, that kind of stuff. And so I think they're using the Red River co-op program. So they get the 15% back while they're students and then hire them on after they've graduated and continue to get a little bit more back. So it's a really great way to lower your costs because, students, while they're certainly, an employee is fantastic, they're still learning, right? So you are investing in them. So this, right, you're investing, right, in somebody that you're willing to train. And so this is a great way to lower that cost.
Okay, that sounds great. Thank you.
Right on. Yeah, definitely. So this is another one where you would get the tax credit refunded when you file the tax return. And it is also important to make sure that you're using co-op vocational programs that are registered, so that if your tax return is ever reviewed, you have all the backup to show that it was part of met the criteria of the program. Okay. Any other questions on some of
Thank you.
these tax credits? Yeah, you're welcome. Thanks for the question, Mercedes. Any other questions on tax credits or anything like that? Okay. So let's move on now to some of the updates on rates and things like that. And this might generate some other types of questions that would come up. So capital cost allowance is a really important part of taxes because when you purchase any kind of asset, so equipment, vehicle, furniture, computers, that type of thing, right? A long-term type of asset for your business, you can't expense the whole thing all at once. You have to depreciate it, which means that you're taking a piece or a percentage of the value of that asset as an expense over time. So CCA, the Capital Cost Allowance Program, is one to be kind of watching for what's going on, because the government will often use this program to incentivize certain types of investments or purchases, but also to limit. So for vehicles, that's definitely a big one. If you purchase a vehicle just for passenger use in your business, it used to be actually for years that regardless of what you paid for the vehicle, you could only depreciate based on $30,000. So let's say you bought a vehicle for $45,000. The most that you can use for depreciation would be 30, and it would be 30% of that on a declining basis. So in the last couple of years, when inflation was really was out of control, Revenue Canada and the government, ultimately the government, not Revenue Canada, the government recognized that that these limits were a bit low and we needed to increase them. So they have been increasing regularly. So now it's up to 38. It went up to like 36 and then 37. And now for 2025, it's 38. So regardless of what you pay for the vehicle, if you pay over $38,000, the most that you can depreciate is based on 38. If it's an EV, electric vehicle or zero emission vehicle, ZEVs, how they call it, the limit's higher, 61,000, because it recognizes our tax system recognizes that those vehicles are typically a little bit higher or in cost, and I think there's an incentive element in there to incentivize people to purchase EVs rather than conventional combustion engines. So those have gone up, and then consistent with that is leasing. So if you are leasing a vehicle, there's a cap on how much you can deduct for tax purposes. It used to be 900. This is another one, even lower, I think 5,900, and this is one that's been going up. It's now going to be $1,100 a month going forward. So $1,100 a month, now at that point certainly buys a decent vehicle. Before, when it was lower, it was kind of just, a little bit more of your entry starter point. So now a little bit more flexibility to make sure that what you're actually paying for the vehicle that you would need for your business, what you can deduct for tax purposes actually fits, right? So there's been some of those increases. With vehicles, this is something that as small business owners, you really want to be aware of, as well as the allowance rates on vehicles. So if you are, allowance rates when it comes to vehicles and travel costs for your employees. So if you are paying an allowance, like a travel allowance to your employees, to make sure that it's deductible for you as your business and not taxable for your employee, like the payment that you're paying them for travel allowance, you need to make sure that what you're paying them is reasonable. And so the first question most people ask is, what is reasonable? So Revenue Canada puts out rates every year that gives us guidance on what is reasonable. So if you're paying an allowance, a reasonable rate would be 72 cents per kilometer for the first 5,000 and 66 cents for each additional kilometer. So this is one that goes up. In the last couple of years, has been going up 2 cents every year. So let's say you're paying somebody $300 a month for a travel allowance. The way you would test that for reasonableness is, okay, how many kilometers are they driving on average? So you take how many kilometers are driving on average each month, times that by 12, that's your total annual kilometers, and then apply this test of the 72 cents and the 66 on the over 5,000 to make sure that $300 is within this dollar limit. And as long as it's reasonable, then it's an expense that the business can deduct against their taxes. And then the payment that the individual, the employee receives is not taxable. Because if what you pay an employee is deemed to be unreasonable, it is taxable to the employee and not deductible for the business. which is very bad for taxes, because really that means that taxes are being paid twice on those same dollars. So you want to make sure that whenever you're paying a travel allowance, that it's always reasonable, because when it's unreasonable, it's double tax. The employee pays tax, and then there's no tax savings for the business. If you have provided a vehicle to your employee, then you need to make sure that you're calculating the taxable benefit associated with the employee having access to that vehicle. And so there is a really great calculator online on our Revenue Canada's website that they use, that you can use, or you just basically fill in what are the vehicle costs and those kinds of things and the kilometers, and it'll tell you what the amount is. But the rates have gone up again for 2025. So they're at 34 cents per kilometer. And if the employee that you provide a vehicle for is like a sales employee that sells vehicles, sells or leases automobiles, and it's 31 cents. That would only apply if you're a dealership or a used car business. But it's 34 cents per kilometer. If you're financing a vehicle, there is a cap on how much you can deduct for interest on vehicles that the business owns that are being financed. It used to be $300, and now it's $350 a month is the most interest that you can deduct. And the last one I wanted to mention here when it comes to CCA is that in the last couple of years, I actually didn't write it as a bullet, but the last couple of years, there was a special program where if you bought an asset, you were able to expense the whole thing if it qualified, if it was in one of the categories that qualified, and many of the categories qualified. So it was quite a good program. And that's now over. So that ended because the eligibility was for anything purchased and available for use before 2025. So now that we're into 2025, no more. So if you did have that in 2024, make sure that when you file your taxes that that program is being used. So let's say you purchased a piece of equipment for $40,000, you were able to expense the whole thing all at once and get the full deduction, which is really great for taxes. If you are profitable, you would want that full expense to save you on your taxes right away. So that's now over, but the accelerated investment incentive program is still available for a little bit longer. And what that one is if you do buy an asset, you can take in the first year when you purchase it, you can take 1.5 times the normal CCA or capital cost allowance deduction in that first year. And it does say, for certain types of property, but many of the classes, the asset classes do qualify. So this is one where if you are looking at expanding, needing to purchase new assets, equipment for the business, you want to make sure you take advantage of this in the next year or two, because it's being phased out. Any questions on CCA, capital cost allowance, vehicles, rates, those kinds of things? Okay. There have been adjustments again for our federal tax rates. We got a little bit of an extra digit in there for 2025, not 2225. We'll correct that before it gets emailed. This presentation gets emailed to everybody. So every year over the last number of years, every year these rates have been increasing, but in the last couple of years, they've been increasing a little bit more aggressively because inflation was higher. And so the tax tiers are important to know, especially, as for you guys as business owners and working shareholders, like if you own a corp, if you're paying yourself either salary or dividends, it's important for you to understand, at what tax bracket, what rates the tax brackets are at. And so now the brackets are always there's always still the 5, so 0 to 50, like the first one is 15%, then 20.5, 26, 29, and 33, as you see. But what has been being expanded or happening every year is the 0 to 50 something has been going up. So a few years ago it was 0 to 50,000, and now it's this last year it increased by about $1,500. I think it was maybe almost 2,000, about 1,500. So now the first $57,000 of income that somebody earns is taxed at 15%. So that's gone up a little bit. And because the base bracket has gone up, the next bracket has gone up as well too. So now it's 57 to 114, 114 to 177, and so on. So this is good to know because, if you looked at a couple of years ago, more income was being captured in the higher tax brackets because, you know, the 57 to 114, it used to be 96. Like it was the high 40s to 96,000 was that tax bracket. So as these brackets, the base one goes up and expands, means more of your income is being captured at the lower tax rates. So why is this important? You know, when you're running as a business owner, how you take income is really important to think about. You have the option, you know, of paying yourself a wage. If you're a corporation, you can even pay yourself a wage as a sole proprietorship, although I don't know why you would want to, but other kind of more detailed topic. But you pay yourself a wage or you can pay yourself dividends. And so whatever you do, it's all taxable. So it's important to understand the brackets. And then we are in Manitoba, so you want to think about the Manitoba brackets. And Manitoba has less than 5. So, but from the federal side of things, we are seeing more income being captured at the lower, in the more income being captured at lower tax rates. The other thing that goes with that, obviously from an income perspective, is CPP. So when if you are deciding to pay yourself a wage, then you have a CPP component. And even if you are a sole proprietor, you need to pay CPP. So what's important to remember is if you, regardless of whether you're a sole proprietor or if you are incorporated and you're taking a wage, you're going to have a CPP, you're contributing to the Canada Pension Plan. So the rates themselves are the same. So the employee pays 5.95%, and the employer pays the other 5.95%. So a total of 11.9% on wages goes to the Canada Pension Plan. Now, if you are self-employed and you're not incorporated, and so you're a self-employed sole proprietor, you pay that whole 11.9% because you are paying both the employee portion and you're paying the employer portion because you're both the employee and the employer. So it is a little bit expensive. So the maximum pensionable earnings has gone up. So basically you contribute up to that maximum amount of wages. So for 2025, it's gone up to 71,300 over the last couple of years. Like it used to be a couple of years ago, it was 66,000. So it goes up every year because it goes with inflation. So 71.3, the basic exemption is 35, which means the first $3,500 of income, there's no CPP applied on that. So if we were to put that to dollars and cents, for anyone that is taking employment income of over $71,000, the maximum would be about just over $8,000, both the employee and the employer portion combined. Now, if you're looking at this just from what you're paying your employees perspective, your cost as an employer is the match, the $4,034.10. That's the maximum that you would be paying. So it's percentage of wages. One thing to remember too, as well, that I don't have here on this slide, that if you are incorporated and you are taking wages from your company, make sure that you're not being deducted for EI if you own at least 40% of the shares of the business. So if you own over 40% of the shares of your business, you wouldn't qualify for EI. So you need to make sure that you're not paying into it. You would be exempt, as well as any related parties to you that work for the business. So if you have family members that work for the business and you own more than 40% of the shares of the business, they wouldn't qualify for EI either. So make sure that when you run your payroll and you have that's set up properly so that you're not paying EI for no reason. There are ways to, if you have been paying EI in the past, there are ways to go to Service Canada to try and get those dollars back, but it's a bit of a process. There's a couple of other good tax items to talk about. If you have this one's relatively new, the labor mobility deduction. So if you are a tradesperson, apprentice, you're working construction, that kind of thing, you're earning that type of income, there's an extra tax credit that you can claim if that's the type of work that you're doing. And then another important tax thing that may or may not be related to business, but I think is really good for people to be aware of is residential property type of flipping. So if you are In the last couple of years, Revenue Canada has really clamped down and is requiring you to disclose when you've sold your principal residence. That started a number of years ago. And now, as a bit of a follow-up to that, as of January 1, 2023, there's been some enhancements to the type of reporting that we're doing, because what Revenue Canada has been finding is that people would purchase a property, renovate it, and flip it, sell it at a profit, and not disclose the sale, say it was their principal residence, and not pay the taxes on the capital gains. So if you have purchased, if you are living in a property, and even if it's your main residence, you don't get the principal residence exemption if you were in that, if you've sold it in less than 12 months. So let's say if I moved in April 1, 2024, if I move out before March 31st, 2025, I would not, and I have a capital gain, it would be subject to tax unless it meets one of the exemptions. So if I have to move because of death, marital breakdown, relocating for work, or moving for school or something like that, or other explainable reasons, which you can submit to Revenue Canada, those capital gains would be taxable. So this is all in an effort to ensure that people are not actually purchasing these properties with the intention of flipping them and profiting them, and then trying to claim the principal residence exemption. So there's more disclosures in that area. So make sure that when you are getting ready for your tax filing, your tax seasons, that you have that conversation with your tax professional. If you have moved into a property, or disposed of any properties, to make sure you're properly fully aware of what you need to report and potentially pay tax on. The other thing that's not in here, because I really didn't want to include wording on that, but I'm sure is on people's minds, is the capital gains inclusion rate. And unfortunately, we're all still a little bit in the dark around the exact correct answer about what to do. So last year, early in the year, the government announced that they would be changing the inclusion rate on capital gains from 50% and increasing it to 2/3. So what that means is that if you sell something at a gain and it is a capital gain, in the past, only half of that income would be subject to tax. So let's say if I sold something for $80,000 and I bought it for 30, I would have a $50,000 capital gain, and half of that would be subject to tax, right? So 25,000. They have they proposed changing that to 2/3, and massively communicated that June 24th, 2024 was the effective date for that change. So what happened last year is many people actually disposed of a lot of property and sold what they wanted to sell and get rid of before that date, to make sure that their disposition, their sale of that property, would be the capital gains would only be 50% included in their income. Because after June 24, 2024, it would increase to 2/3. So unfortunately, where we're still at, though, is as of now, even a couple weeks ago, before the recent announcement of the Prime Minister intending to step down, that change actually wasn't fully approved yet through the government's process. It was still pending approval. And so everyone's been kind of like, what are we going to do? Do we, our tax time is coming up. Do we include anything that we've sold after the June 24th at 2/3, or do we use 50%? And unfortunately, the answer is still unclear, and a little bit more unclear now that we have government in a little bit of a pause, because government is currently prorogued, and with the Prime Minister stepping down, not sure what it looks like for getting anything approved. So this is one thing that you kind of want to stay in touch with. You can't change what's happened in 2024, because if you did sell something, it's sold. You can't get away from disclosing that disposition, but what you include in income on your tax return is still up in the air. So keep in touch with your tax professional on whether you should be including it at 50% inclusion rate or the 2/3. And hopefully over the next month or two, we'll get some more clarity from Revenue Canada on what to do. Any questions on any of those things? Okay. A couple more tax planning considerations. These are really important, regardless of whether you're self-employed or a working shareholder, or if you're an employee somewhere. These are really valuable tax planning considerations. So the basic personal amount is still $15,000. So basically meaning your first $15,000 of income isn't taxed, because you would get a tax credit of 15% on the $15,000. But if you earn $15,000, the first tax bracket is 15%, so it's a wash, right? But for higher income earning individuals, if you start earning more than $235,000 in a year, which sounds like a lot, but as if you're successful, self-employed, working, even employed person, you may be hitting these thresholds, the basic exemption starts to go down. So the more you make, the less of your income is exempt from tax. The tax-free savings account has the contribution limit for 2025 is $7,000. So if you were at least 18 years old when the program first started, your limit going into 2025 would now be $102,000. So this is one type of investment account that if you are putting away for savings, this is one that you want to prioritize using first. Any money that is in this account, however you have it invested, whatever it grows by, none of that income is taxed. So if I have $50,000 in this TFSA, and let's say I have it in a GIC, right? And I earn 5% of interest income, that $2,500, 5% of 50,000, it would be tax free. There's no taxes on that ever. Like that is pure tax savings for any dollars in this type of investment account. So this is one that if you are putting away for savings, you want to put here first. RSPs are certainly very important. And if you don't have any kind of pension plan, you want to balance this with TFSA, of course. But the TFSA is pure tax savings. An RSP is tax savings today, which is fantastic because in your working years, you're typically in a higher tax bracket than when you retire. So when you take out your money from your RSPs when you retire, you'll be taxed on it then, but hopefully you'll be in a lower tax bracket. So for 2025, the limit of what can go into the RSP has gone up. It's still based on 18% of whatever your earned income was last year. But if your earned income is really high, it's capped at $32,490. If you don't use the 18% of your income, that contribution room that you've earned, and you don't use it, you don't contribute to the RSP, it carries forward. This is one that you don't lose. So from a tax planning perspective, these are really important to take a look at and to incorporate into your planning, into your income planning. There's another one that people are talking a lot about, the first time home buyer savings account. I don't have text on here about that, but if this is one that you have any questions of, you can certainly ask. Quite briefly on it, it is another plan that is pure tax savings if you are saving for your first home. Maybe as self-employed, if you're a little bit, later on in life and you're not planning on buying your first home. The reason I bring it up is we talk about it a lot with our clients that are maybe in a position to help their kids with their kids' first time home purchase. So if you're going to be giving money to your kids anyways to help them with the down payment or something like that with the purchase of a home, have them put the money into the first time home buyer savings account. Because whatever money they put into the account, up to $8,000 per year, once they start, they get as a tax deduction. So they save right away on their taxes and they don't ever have to pay tax on that money. Because as long as the money is used to purchase that first home, that money is never taxable. So that the first time home buyer savings account is pure tax savings. So if you are in a position where you're going to be helping kids or your kids or purchasing your own home, that is definitely an investment account to start and use, and talk to your banker about, financial planner, whoever you might use. Good, we got that link there from Eric. Appreciate that. Any questions about any of those things? Okay. So we'll move on to our last piece here. So just wanted to include the Canada Dental Benefits Program that the federal government has rolled out over the last couple of years. Very, very new. And this is good to know about because, especially if you are self-employed, you may not have dental benefits available to you if you're not, you don't have a health and dental plan as part of the company yet. So there is the Canada Dental Benefit Program. Right now, it's still there. It's still set up to support families that earn less than $90,000 per year. So it is still targeted towards not low income, but lower income, low and lower income individuals and families to ensure that they have some kind of dental coverage in place. When it first started out, it was just for kids that are 12 and under. So right now, the program is open to seniors age 65 and over, children under the age of 18, and any adults that have an approved and in place disability tax credit certificate. So even if you yourselves are not in this category, if you have kids under the age of 18 and as a family, you are within that income threshold, this is something that's important to make sure that you apply for and have in place so that when, you're at the dentist and the kids have that bill come up, then this is something that has some, you use the coverage that's available. And so one of the other things that's important to know as an employer is when you produce your T4s for your employees, there is coding that is now required on the T4 tax slip that you have to indicate what kind of coverage you are providing to your employees. And so the reason that's important is that if you put the code that they do have coverage, Revenue Canada will know, the government will know that those are people that may or may not qualify for the program, because if you have coverage in place, you're not going to have the same eligibility. But if you don't offer them any kinds of health or dental benefits, then you would code that as a no, as a zero. And then Revenue Canada knows, okay, this is the potential part of the demographic that would need, that is probably going to need dental coverage, right? So it is an added requirement onto T4 production that started recently to make sure you keep that in mind and to coordinate with whoever's doing your payroll, whether it's yourselves or staff person or provider, to make sure all that coding is up to date. Okay, so that takes us pretty close to the end of the hour. And I've reserved the last 10 minutes or so for any kind of questions.
So thank you, Peter. Thanks for all this great information about taxes. So yeah, if you guys have any questions, feel free to send it in the chat or raise the hand feature there.
Yeah.
Mercedes, I'm in the health private practice program. What do you know about no charging GST in counseling and psychotherapy?
Yeah, so I know that there have been some very recent developments around this, and I know that it's a complicated problem because each province has their own definitions. And the reason I know about this is because I have a client. One of our clients is a clinic, and that has some of these services being provided. So I am a little bit up to speed on it. The challenge is that each province defines what is counseling, psychotherapy, these types of counseling programs, and based on that definition, then you have to tie that into the federal government's definitions on the GST program about what is GST, what is an exempt service and what is not. So I know that in Manitoba, there was a recent win where the services have now been included as exempt. So this is one where I don't want to give you a hard yes or no about whether you should or not, but I know that if you check with your association, but I know the association, especially around psychotherapy, just got, I think it was towards the end of December, just got included as now being GST exempt. So double check with your association, because it was on the association's websites across Canada about what their success has been with the federal government on negotiating the definitions for this and what's in and what's out. But I'm pretty sure now that if you are doing the counseling and psychotherapy under mental health and you're part of that association, then yes, you'd be now exempt. But what is important to understand about this is if it is exempt under the GST program, then that means you don't get the GST back on any GST that you pay for running your business. So It's something to be aware of, but then you don't have to collect the GST from your customers anymore. If they're saying that you're 0 rated, then you can still get the ITCs back. You can still get the GST back that you've paid. So circle back with your association to make sure that you are included by definition, and then you can change how you're collecting the GST. I need to answer it that way just because I don't know all the details of the business and it's tax advice technically. So that's the reason I've kind of pushed you back to that. But there have absolutely been recent changes to include your types of services. Yeah. Thanks, Mercedes. Other questions?
Peter, since you're an accountant, I get a lot of this question. Should you get a bookkeeper?
Oh, that is such a good question. Yeah, so there are a number of ways to answer that. So I will start off by saying how I usually answer that with a client. So in our practice, we are a public practice firm. We do tax, and that's why we're public practice. We're not auditors. I don't like audit, but we're public practice because we do tax. And so we will do bookkeeping services for clients. To help, if they need the service. But how do you decide whether you need a bookkeeper or not, or need to engage in a third party for bookkeeping services or not? So there's a lot of really great software and programs out there that will help get you started, and I think are really important for all businesses to have. Whether you are a one-person show as a sole proprietor, there's great subscription-based platforms that do an excellent job of helping you organize your books. Um, and all the way up to where you have a lot of employees and you have lots of sales and all that kind of stuff. But in terms of whether you need a bookkeeper or not, this is generally what I tell the client is, if you are spending your time doing admin and bookkeeping and coding receipts and posting and all that kind of stuff, and you're spending your time doing that and it is keeping you from generating revenues, you need a bookkeeper, because it doesn't make sense for you to spend your time to save yourself anywhere from $40 to $60 an hour from a bookkeeper who can probably do it at half the time than what you're doing it in. Doesn't make sense for you to save yourself that cost when it's costing you working on your business. And that's another saying that someone that I've worked with said before, is, do you want to be working in your business or do you want to be working on your business? If you're working in your business, that's great, right? If you're self-employed because this is what you want to be, that's your job, that's what you want to do, then that's fantastic. But if you want to be working on your business to grow, to get to that next level, right, to increase wealth and those kinds of things, you're not going to get there if you're spending your time on activities that is not generating sales, right? That is not generating growth. You're not exploring new markets. You're not developing new products or services. That's not effective. Because bookkeeping in general is going to range from 40 to 60 bucks an hour. I mean, our firm, we're probably right in the middle of that, because, it's, you want to be competitive, but not overly pricey. But it's an important service, because if you do get certain things wrong in your bookkeeping, you could likely, those things compound. So you're going to likely be missing out on certain tax deductions. You're going to be maybe missing out on GST type of claims and those kinds of things. We have one client who insists on doing it themselves, and we showed them, we took a look at what you probably missed on GST, and it was about $3,000. It's a lot of money. We have another client where we took them over and cleaned them up, and we got them back about $25,000 in taxes after we corrected and refiled a lot of their books. And that's a lot of money, right? So it depends on how you want to be spending your time. This is really the best way to answer that question. If you can do better with your time on generating sales, don't be doing your books. There's plenty of talent out there that can help you do bookkeeping. It's busy. It's a tough, dry market right now in accounting, bookkeeping land, and there's a lot of not so great service providers out there. So definitely shop, but that's how I would answer that question in a really long-winded way. Sorry.
Yeah, no, great. Thank you.
Other types of questions?
Does anyone else have any questions? If not, I just added in the chat some of our upcoming webinars and events. So on January 16, we will have our first FIT course, so FIT Skills for Manitoba, powered by the World Trade Centre Winnipeg. The topic will be feasibility of international trade, and that will be hosted by Carolyn Osborne. On January 22nd, we'll have our first WTC Talks of the year. That will be hosted at Shrugging Doctor Beverage. And the guest speaker will be Howard Lowen, CEO of Micropilot, and Monica Morozen, marketing manager at Illumia Labs. And we have our business planning program on January 28th. We had to reschedule that. That will be with Rosalie Harms, also a CPA, and works along with Peter. And yeah, if you guys have any follow-up questions, feel free to reach out to Peter or myself. I will put my contact information in the chat.
If any of you have not been to any of the Shrugging Doctor, I think they got that their location there in St. James area. It's fantastic.
Yes.
It is so good. Okay, well, thanks so much, Eric, and all the participants today and attendees. Really appreciate everybody joining, and have a great rest of your day. Be productive, and go out there and kill it in the market.
All right. Thank you, Peter.
All right, take care. Bye now.
Have a good day, everyone. Bye.